welcome everybody. Let's go ahead and get seated here in the room. I want to welcome everybody to our seminar, our workshop on the 2017 Tax Reform Act. I'm David Morrison. I'm one of the partners and LPL financial advisors here at Prosperion Financial Advisors. I want to welcome our guests here in the room, as well as more than 30 people online. So we're happy that all of you are joining us this morning. So I heard it said once that if you were to take all the tax attorneys in the whole world and you gather them up, you put them all in a big group, and then you just stack them one on top of the other in a huge pile extending way up high and out into space, that would be a good thing. And we have tax reform now that is set in law, signed by both houses of Congress, signed by the president. And so, as a follow-up to our workshops in December, we've asked Dahl to come back and tell us what actually happened, what were the things that we anticipated, and what actually happened. So we've got a great workshop today. I will just introduce you to Jay. Jay has been practicing as a CPA for more than 30 years. He has his own practice here in the Denver Tech Center. His contact information will be on some of these slides and available to you guys. We'll email it out after the broadcast, and you have the presentation. You'll see the presentation here. And if you have questions as we are working through this, for those of you in the room, please go ahead, raise your hand, and Jay will answer your questions as we move along. For those of you online, just email or call your advisor, your LPL advisor, your Prosperion advisor, and we can get in contact with Jay if we don't know the answer to your questions. So, but we're happy to have you here, Jay. Thank you very much for joining us, and have at it.
All right.
Very nice.
Thank you. As David said, my name is Dahl. I was here in December and did a preview of what we thought was going to pass because it had gone through the House and the Senate was still debating, and not everything we talked about passed. And so things changed. But before we get started, I do have to apologize. I misspoke in the December session, if anybody was there, about donor-advised funds. I want to set the record straight. They are deductible when you make the contribution to the donor-advised funds. The old rules were that you had to wait till they invested those or passed those on. The new rules, as long as they put a statement on their statements to you that say you do not have any access to those funds, you don't get a refund, if you will. Those funds are totally deductible at the time you contribute them to the donor advised fund. So wanted to get that out of the way. I'm human, we make mistakes. So, but the good thing is we own up to them and we fix them. So as we go through this, if you have any questions, or if you have a different understanding, please raise your hand or ask the question. You know, my first job, how many people remember their first job? I tell people I worked at a calendar company, but they fired me after I took a day off. Now, some people get that and some people don't. But I am the typical accountant. I hate to make mistakes. I'm kind of anally retentive. The accountant's prayer says, Lord, help me to relax. Be more relaxed about insignificant details. Starting tomorrow at 10:53 and 16 seconds Eastern Standard Time. So you want somebody who's a little anally retentive. You want people who understand the law and are going to look out for your best interest. So we'll jump in. The big thing are the tax rate changes. So this affects everybody across the board. If you remember, it used to be that married couples paid more tax than two single people. And then in the Bush administration, they went and they doubled the marriage tax rates to that of a single person and eliminated that. And then Somehow in the last 10 years that got diminished, tax rates changed. Well, the Tax Reform Act fixed that. So when you look here, this is double this, this is double this, this is double this. Whereas previously, you can see that it wasn't double. So single people will actually have maybe a little bit more tax. The brackets will become effective sooner than they would have, and married couples a little bit later than they would have. So part of the Tax Reform Act is that fixes it. The other thing is it dropped from, the 10 stayed the same, dropped from 15 to 12%, 25 to 22, 28 went to 24, 33 became 32, 35 stayed the same, but notice the changes in the tax bracket itself. So you get more income at the 35% instead of jumping into the highest tax bracket, which has been lowered from 39.6 down to 37%. And so you get a bigger tax break. And so yes, those people that make more money will save more taxes, but the tax cuts do affect everybody. Long-term capital gains tax rates really didn't change. You still have 20%, 15%, to 0%. If your income situation fits appropriately, you can have zero tax on some of your capital gains. You would need to run some scenarios to make sure with your advisor and your tax professional to see if that affects you. Bad news is the 3.8% net investment income tax is still there. So dividends, investment income, capital gains, if your income is high enough, you pay an extra 3.8%. You don't have the likelihood of having tax preference items, though. For alternative minimum tax for corporations has been repealed. The AMT for individuals has changed, and the exemptions are higher, and the other effects that come into play are, as most of you are aware, local and state tax is limited to $10,000. Well, it used to be that was a large tax preference item. So being limited to $10,000, that also takes a lot of people out of the AMT situation. Alimony. This is a big change. If you are currently paying alimony, it is deductible and the recipient is supposed to claim it as income. Statistics say that 100% of people who pay it claim it as a deduction, but only 50% of the people who receive it claim it as income. What happened is the IRS was getting involved in litigation, so they would send a notice saying, you didn't claim all your income. Well, then the recipient would send a copy of the divorce decree, and we all know those are exactly the same across the country. And the IRS felt like they were getting into the middle of divorce situations. What's taxable, what isn't, what's child support, what's alimony, and they decided that that's not where they belong. And it took so much of their resources in tax administration. So for decrees after 2018, it's not going to be deductible by the payer, and it won't be taxable to the recipient. The bad news is if you're in that situation, it's still deductible and it's still taxable income for decrees prior to 1/1/19. So it doesn't change, but it has an effect on current divorce cases and how rulings are going to go in the negotiations as to the dollar amounts. Child tax credits used to be $1,000 for children under 17. They raised that to $2,000. There's a portion that's refundable up to $1,400. So not all of it is a refundable credit. Depends on your tax liability and your personal tax situation. However, if your child is in college, more than 24 years old, just had this question yesterday, a master's degree, graduate school, did not earn more than $4,100 And I don't know if that rule is still in place because personal exemptions have gone away. Then you may be able to still qualify your child as an other dependent on your tax return, and you may still get a $500 tax credit. Again, your personal circumstance, check with your tax professional to see how that may apply to you. Individual mandate, dangerous, dangerous, dangerous. It's still in effect for 2018. So you would still have the penalties for not having coverage in 2018. It goes away 1/1/19. So in 18, that excise tax still applies. And because they had all the open enrollment in December, and by the time the tax law got passed, everybody had already signed up for their insurance. Now, it's estimated that 13 million people will drop off. This is not that they're going to be dropped from their plan. This is the individuals coming out of college, feeling healthy, feeling good. I don't need any health insurance, and they're not going to pay the premium because it won't be mandated that they have to. So as these people come off, then it's expected for premiums in 19 will maybe jump 10% at least. That's the estimate at this point. We'll have to see what plays out. So we'll just see what college kids. Itemized deductions. It's estimated that 37% of Americans itemize on their tax return. They doubled the standard deduction. So single this year is $6,400, $12,800 for individual or for married couples. It's going to be $12,000 for single filers, $24,000 for married filers. They did preserve the special deduction for people over 65. You get an extra $1,300. So if you're a married couple, both over 65, you get an extra $2,600. So that becomes $26,600. And that includes the year that one of you may pass away. You're called a surviving spouse in that year, and after that you file a single, and it jumps to $1,600 as an extra deduction for you. Medical expenses. They had an age bracket that said some people had a 10% limitation on medical expenses, and older people had a 7.5%. Well, the Tax Reform Act said it's going to be 7.5% for 17 and 18. One of the very few retroactive provisions of the Tax Reform Act that happened. And you have to remember, this was signed by the president on December 20th. So today's the 26th, so we're talking 5 weeks ago. So there's still a lot of digestion going on, a lot of analysis. But this is a good thing. State and local taxes. A lot of questions about this. Limited to $10,000, and that includes state income tax, personal property tax on your principal residence, and second home. And if you were in a state that didn't have income tax, South Dakota, Texas, Wyoming, Nevada, and you use the sales tax tables, that also has a limitation on it. So how many people went out in December and tried to pay their property tax or made an estimated tax payment beforehand? What's your understanding of that right now?
Well, we paid it early because we don't think we're going to be able to do $24,000 of deductions next year. So the thought was prepay your property tax.
Do you believe that it's deductible on your 17 tax return? Because what he said is that they prepaid it in 17 because they didn't believe they were going to itemize, meet the $24,000 limit in 18. And the IRS came out with guidance that said if it's not assessed as of 12/31, it wouldn't be deductible on your 17 tax return. And everybody goes crazy.
So I wasted my time.
Because it isn't assessed. In my county, it's not assessed.
Well,
they just gave me an estimate.
Right.
And they said it wouldn't be assessed until after January.
Right. Now, I've talked with other CPAs, I took a 2-hour class, and what we came up with is your cash basis taxpayers. Deductions happen when you pay them. People made their estimated state income tax deduction in December instead of waiting until January because the $10,000 limitation, and people ran out and paid their property tax. Our personal position is that we will take that deduction on the 17 tax return if you paid it. Because cash basis taxpayer, they came out with guidance that said, no, they wouldn't allow it. First of all, how are they going to audit it? But second of all, how do you override years of tax law, tax regulation that says that deductions happen when you're paid on a cash basis taxpayer, which most individuals are. So I wouldn't have a lot of anxiety over that particular situation. But make sure your tax professional understands your position. And I should also say, with that, high tax states, notably New York and California, are trying to pass legislation and set up things that will give you a deduction. California is investigating whether they should set up a charitable foundation where you can donate to it and they will give you a dollar for dollar reduction in your state tax liability. Now, where's Lois Lerner when you need her? From the IRS. She was the agent who rejected all these applications for tax exempt status. So it'd be interesting to see if California does that foundation, whether the IRS will accept it as a legitimate charitable foundation and give them an exemption. New York wants a $1.5 billion increase in tax revenue as part of their new budget. Now, they can raise their corporate tax rates, but they're looking at individuals. The interesting thing about New York is that since 2010, they've lost 1 million people. And last year alone, 190,000 people left the state of New York because of high taxes. Well, that was the main reason given. I'm sure there's others. So politicians across the board like to see where your money's at. California is also proposing an increase in their state corporate tax rate because the corporate tax rate dropped from 35 to 21%, a 14% drop. And they would like to, they think they're entitled to a 7% increase in their state corporate tax rate. They're entitled to 50% of the tax break the federal government just gave corporations. The only comment I can make about that is I find it interesting that Apple is looking for a headquarters number 2 and Amazon is looking for a headquarters number 2 that are not inside the state of California. Stay tuned, the future could be interesting. Charitable donations. There are 3 types of organizations that you could give your money to. 50%, 30%, and 20%. And the organization gets a determination letter when they file for their exemption that says which one they are. What that is it puts a limitation on the donation you make to them based on your adjusted gross income. So most, like United Way, Salvation Army, Red Cross, used to be 50%. You could deduct 50%, donations up to 50% of your adjusted gross income. So if you made $100,000, your donations would have been limited to $50,000. They changed that to 60%. So if you are charitable minded, you might have a bigger deduction on charitable donations on your tax return, depending on your adjusted gross income. But if everything else stayed the same, you can deduct more of your charitable donations. This is a point for tax planning. Talk to your advisors about this as well. If you're not going to be able to itemize because the $24,000 or the $12,000 and you're retired and you have to take required minimum distributions, you can make those charitable donations through your R&D, and it would reduce the adjusted gross income on the front of your tax return. So while you may not normally be able to itemize and take the charitable donation. This is one way around that, and you still get the benefit of making donations, reducing your taxable income, and getting the standard deduction. So this is something you should seriously consider. Any questions so far?
Was there any change to the 20 and 30% organizations on the charitable deduction?
The question is, was there any change to the 20% and the 30% charitable organizations? The answer is no. Just the 50, the top end. And those 30 and 20% organizations are usually private foundations of some sort. They're not, they cannot illustrate more than 33 1/3 of their support from the public, general public donations. Mortgage interest. You can deduct the mortgage interest you pay on a purchase loan on your principal residence and second home, as long as the principal portion is not more than $750,000. If you buy a home and it's $1 million loan, 3/4 of your interest becomes a deduction on your tax return. The other 25% is lost. Purchase loans prior to 2015 are grandfathered. I do have some clients with $900,000 mortgage. They'll still be able to deduct 100% of their mortgage interest. But if your loan closed after 12/15 or you refinance, you must illustrate that the principal portion went through. So if you take cash out, the cash out is considered equity loan, no longer deductible. HELOCs, home equity lines of credit, not deductible unless you use them to improve your home. You know, if you want to do an addition, redo the kitchen, put a deck on, do things that increase the value to your home, those loans are still deductible because it's part of the purchase of the home itself, whether it's an addition or the principal residence when you first got it. That makes sense? This is a good thing. For people who used to earn more than $320,000, you experienced a reduction in your itemized deductions. So if you made $520,000, you had $200,000 excess times 3% or $6,000, a reduction on your itemized deductions. So if you had $30,000 in itemized deductions, you were able to deduct $24,000. That provision, called the Pease Amendment, is repealed. So if you're, again, a high income earner or high income taxpayer, you may get more itemized deductions than you previously been able to take. $2% miscellaneous itemized deductions are gone. That's tax preparer fees, investment advisor fees, legal fees for the preservation of income. The other one is the unreimbursed employee expenses. So everybody employed have a W-2 income, or is anybody self-employed? Okay. Form 2106 is what this refers to. So if you're a sales guy, saleswoman, salesperson, pardon me, and you have unreimbursed mileage, you get reimbursed 30 cents a mile, and in 18 the rate is 54.5 cents a mile, and you've been able to put this on your personal tax return, or you buy a new computer, or you have meals that aren't reimbursed, no longer deductible. So the encouragement is to have your employer reimburse you for all your costs. It should not go on your W-2, and they get the full deduction at that point. But that's something that people should consider if you are used to being able to have unreimbursed employee expenses as a deduction. Oops, too far. Gambling losses. To the extent of winnings are still okay as an itemized deduction, they were never subject to the 2% provision. But even professional gamblers had some limitations. So if you're a big gambler and you have certain circumstance, rather than get into the weeds at this point, talk to your tax professional. And maybe your investment advisor who should tell you that this isn't the best way to plan retirement. That personal, not personal experience. Not part of the final bill. The adoption credits are still okay. Teacher supplies up to $250. We thought they were going to raise that to $500. They did not. Did you have a question, sir? Any questions at all so far? I mean, there's been so much media exposure to this tax act, and everybody has an opinion about what it's going to do and what it's not going to do. In December, we talked about this provision where they were going to propose that you must own your principal residence 5 out of 8 years before you would be eligible for the gain exclusion. The good news is that did not pass. And when we talked on Friday, December 15th, you can imagine the lobbying that took place on Saturday and Sunday and Monday before they passed that by the Bankers Association, realtors, and with such. Anybody involved with real estate was having a heart attack. So it remains 2 out of the previous 5 years. It remains at $250 for a single person and $500,000 for a married couple. Student loan interest, still limited to $2,500 depending on your income level, and maybe non-deductible depending on your personal tax situation. I feel like this is a significant change. Section 529 plans. Does anybody put educational funds away for their kids or grandkids, nieces, nephews? Usually College Invest in Colorado would give you a deduction on the state income tax return, and it was limited to higher education, college. Now, the new act says you can spend up to $10,000 out of that 529 plan for private grade school and high school. Big change, but that's limited to $10,000. Higher education, college, still unlimited. Yes, sir.
Other expenditures.
Yes.
Not contributions to it, but
right. But your expenditure, the cost of education out of the fund is limited to $10,000. You can still put money in. Talk to your tax advisor. There's certain rules you can give. The tax. Let me restate that the gift tax deduction this year is $15,000. It used to be $14,000. So there's a provision where if you want to donate to a 529 plan, you can put $75,000 in. You file a form 709, which is a gift tax return, and you make a 5-year election that says you just made $15,000 times 5 years, and that way you can fund it instead of waiting to put 15 in, 15 in, 15 in, 15 in, and 15 in. You get more money working for you sooner, and right now the investment environment seems like it's pretty good. So that's why you can put that money in, you don't pay tax on it, you spread it out over 5 years. That provision is still there, so you have to be careful. Colorado does have some limitations, other states have some limitations as to how much you can contribute. Yes, sir. David.
The $10,000 annual limitation is on school expenses per child.
Yes.
So if you have more than one child in private elementary school, you can go up to $10,000 each.
The question is, does the $10,000 limitation apply per child or per family? And it's per child, per 529 plan. Usually you have a 529 plan for each child.
That was my question.
That was your question as well. Yes, sir.
The acceleration of the contributions to 529, is that a 3-year or a 5-year?
It's a 5-year.
5-year.
That you can take that. You make an election on the 709 form. You file the form. It tells the IRS that you've made gifts subject to the annual limitation. It doesn't affect your estate taxes or the unified credit. which we will mention later on. Another question, again, are the states going to adjust this? Because the feeling is more people are going to contribute to a 529, Montessori schools, possibly religious schools, other private grade school and high schools. So we haven't seen any indication so far, because it's estimated that out of this tax act, states with lower income tax rates, in Colorado's is 4.63%, states will benefit from the tax act. Colorado is expecting about a $300 million increase in tax revenue. You're trying to figure out if that goes towards education or if it goes towards roads. That's up to the people we elect. But are they going to adjust this deduction? We don't know. The state taxes, they doubled it. There's been a lot of numbers thrown out. I saw 10 million and other ones, but what the 10 million refers to is back in 2011 when they raised the estate tax limitation or deduction to $5 million per person. Congress, with this tax act, doubled that to 10 million. However, it's been adjusted for inflation. So when the 5 million became $5,490,000 exclusion for 2017, they bumped it to 5.6 is what it was going to be, and they did double the estate tax deduction to $11,200,000 per individual. And if you're married and one of you passes and your estate hits these, you must file a 706 form to preserve the rollover, and the married couple between them gets $22.4 million exclusion from estate taxes, depending on the size of the estate. So they figure this will take a lot of people out of that scenario. With my luck, my wife will die, I won't do it, I'll win the Powerball, and then I'm screwed. So I hardly play it at all, but and not a good retirement plan, to reiterate that. Plan is still necessary because you still want to have a little bit of control from the grade, who gets what. You still want to identify if your children deserve, in your mind, this or that. The other aspect is, I had a client that had $3.5 million in IRAs, and they were having them all go to a trust. A trust will pay taxes much faster and much higher than individual beneficiaries. They had a special needs child. It was a blended family. We felt like they got bad advice, and it was very hard to have that discussion because the tax impact of their estate plan was going to be large. So your estate plan can cover a lot of things, but you really need to address the tax issues as to who's going to pay what, what's going to happen with those monies, and are your heirs going to get all the money you expect that they're going to get? Because Uncle Sam will jump in there. And my understanding was, I think it was Baltimore, you could lose up to 90% of your estate under the old rules. I don't know what municipalities or states or counties have done to address the state taxes at their levels. So a plan, absolutely necessary. You know, a goodwill, maybe a trust, maybe not. There's a state tax, estate attorneys, your investment advisors. Some of your tax professionals have good contacts. If you're doing an estate plan, don't wait too long. Property transfers, in December we talked about that, and if the estate tax had gone away, then the stepped up basis provision in estate taxes was going to go away as well. So if you bought a home in 1940 for $10,000, and now it's worth we'll say $6 million last year, and you died, there would be some estate tax because it was above the provision. Under the old rules, your heirs would have a property worth $6 million, and that would be their basis. There was a scare in there that said, hey, their basis would have been $10,000 if there was not an exclusion if the estate tax went away. So there's a give and take in estate taxes. Who's going to collect what? And as I've said before, they're going to change the national model from "In God We Trust" to this. It's your money. Why should you have it? Big deal. It's always interesting. The other aspect is all these provisions sunset in 2025. So there's going to have to be some other bill, some more other tax legislation that addresses this. Yes, sir.
You ever heard of a ladybird provision or ladybird transfer of property?
I have not.
What does it mean?
We've got a client asking us about the ladybird provision of an asset transfer, and I don't know a thing about it. I just wondered if you might.
The question is if we've heard of a ladybird provision for asset transfers. Yeah. And that is not something I've actually, but we have an estate attorney who made that.
A Medicaid planning tool.
What?
Medicaid planning tool.
That is a Medicaid planning tool, apparently. In my understanding, and please correct me if I misspeak, is that in order to qualify for Medicaid, there can't be any assets for 5 years. That a lot of families transfer money into trust and gifting so mom or grandma can qualify for Medicaid for nursing homes and other situations that may be needed in the future.
Like a 5-year look back.
It's a 5-year look back on when those transfers take place. So if we're qualifying. Now you know what I know. So talk to your financial advisor. Can't stress it enough. Find a good estate planning attorney to talk with. These kinds of things make a difference. So sunsets. And I not a lot of questions.
Jay, you may be getting to this, but gift taxes is the annual gift tax exclusion. You said $15,000 a year, but then is it unified with the 11.2 as far as gift taxes?
The question is the annual gift tax allocation or exclusion of $15,000 starting this year. Is that part of unified credit, which affects the 11.2 or 22.4? And the answer is yes. So if you gift somebody $1 million, you can gift them $1 million. You won't pay tax on it. They don't pay tax on it. But now, if you're an individual, your exclusion may become, well, let's say you gift them $1,015,000. The $15,000 is clear. The million reduces this to $10,200,000, because this is done through a unified tax credit that happens on Form 706 when the estate tax return is filed.
And so, pardon me, it's either 11.2 at death or during life.
Or during life, correct. This exclusion may be reduced depending on how you gift throughout your lifetime. So, trusts and such can be useful tools in having asset transfers to your heirs. Anybody's, I know at least one self-employed. Anybody else self-employed or pass-through entities? Because real quick, corporate tax rate dropped from 35% to 21%. I already mentioned how New York and California are trying to figure out how to get some of that money back. But it's, I think the number was yesterday, at least 217 companies have given bonuses to their employees of at least $1,000. Walmart was one of them that announced, and then they closed some Sam's stores. But you know, giving bonuses out, hey, I'd take $1,000 if you wanted to give it to me. who couldn't use it because these companies are looking at a nice tax break and they want to take care of the people that work for them. If you have a small business, you can write off equipment. There used to be some limitations. What they're saying is up to $1 million, you can just write it off. Bonus depreciation as part of that provision is increased to 100%. It used to be 50% and 30% depending on time frames. If you have a small business and you have a line of credit or a big loan, interest deduction is limited to 30% of taxable income. So if you make $1 million and you have $100,000 taxable income before your interest deduction, you can deduct $30,000 of your interest deduction, of your interest paid. Entertainment no longer deductible at a corporate level. Country club dues were never deductible. Chamber dues are, but golf outings, tickets for the basketball game or hockey or football, entertainment gifts, no longer deductible at a corporate level. So meals are still 50% deductible. There was a provision that said if you have a meal, it's April 10th. I bring a meal in for my staff because I don't want them running away with 10 days left in tax season. There's 7 days. And so I bring a meal in so everybody can eat. It's for my convenience. They work at their computer or take 10 minutes. No longer deductible. However, employee social events are 100% deductible. So we're going to have a hoedown every day at lunchtime for 5 minutes.
No kidding.
It's absurd. How can they verify these? You know, and they would waste more time trying to audit these deductions in the long run. But this is for my employees only, so don't show up expecting square names. Found this interesting, just given the times. No deduction for sexual harassment or sexual abuse settlements if the settlement includes a non-disclosure provision. This was generated by Hollywood. That said, you know, all these guys were taking all these things. Well, Weinstein is the most notable, and all these women had to sign non-disclosure and all the above, and then the environment changed in the last 6 months. So they built this into the tax code. I find that pretty interesting. I don't know what else to say about it.
There won't be no more non-disclosure.
Maybe you should just keep your hands to yourself. What a concept. 20% pass-through reduction. It affects a lot of small businesses, but it also affects individual investors who have real estate investment trust, like a REIT, or REITs, depending on how you pronounce it. Depending on the circumstance, this may come into play. They have specified service, trade, or business. Is any trade or business activity involving the performance of services in the fields of health, law, accounting, actuarial science, performing arts, consulting, athletics, financial services, brokerage services, any trade or business that the principal asset of which is the reputation or skill of one or more of its owners or employees. Excluding, I know this man's an engineer, engineering and architecture. You guys must have a heck of a lobbying group. And actually, I think there's more of the home builders, a lobby to be excluded. So that involves the performance of services that consist investment or investment managing, trading, or dealing in securities, partnership interest, or commodities. However, the deduction may apply to income from a specified service, trade, or business, this whole list, if the taxpayer's taxable income does not exceed $315,000. So small businesses that are still S corporations, and I understand this applies to Schedule C, E, and F. and E is the partnerships and S corporations. I haven't seen the complete application on how that gets handled with investment, rental real estate, or self-employment. But I've been told that it applies to it. I have seen the application for S corporations, partnerships, based on your percentage ownership and the such. Between 315,000 and 415,000, for people like myself, that fades out, and then I'm no longer able to get this 20% reduction if my taxable income goes over 415,000. Again, extremely important to talk to your tax advisor and your investment people to say, does this apply? Does it not apply? Some of the provisions in here about being able to have that on an S corp, owners' reasonable wages. It's been a horrible situation. A lot of small business owners create an S corporation, think they don't need to take any wages, don't take a W-2, may or may not take a 1099 contract labor from the company and put it on their personal. This will not apply to that situation. So reasonable wages out of an S corporation are going to become one of the triggers that says you're entitled to this reduction in your income. Applies to individual tax situations. So something to take a serious look at. If you're not in any of these fields, I have a contracting company that does building and everything. It does $5 million. Now we still have to make sure they're still taking reasonable wages. But what a tax break for them. You know, what a good deal. It's only two owners, 50-50. So what a nice application. May or may not apply to you, but extremely important to take a good look at if you're self-employed or invested in a small business. Any questions, comments? People going to run out and become incorporated?
Is this 20% on the distributions or the W-2 wages?
On the net, it's qualified business income from the organization. So from an S corporation, if I make $100,000 and I take $50,000 in distributions, that's not, because I'm paying tax on the full $100,000. So distributions are not reflective of your actual taxable income. So the qualified business income is 100. I'd get a $20,000 reduction. If you're in the 22% tax bracket, you just save $4,400 federal tax. So it depends on K1s that come through is probably the best indicator from partnerships and S corps. Questions, comments? We are way ahead of schedule. That is actually my last slide. In the past, I've received a lot more questions, but does it make sense? Is there something that you've heard that you don't think we've addressed?
Was there any changes in retirement plan contributions besides just the normal?
No, 53 up, the 54,000 is the total. There hasn't been any change in that.
Okay.
I think that's a great question. The question was there any change to retirement plan contributions? But one of the things that will need to be looked at, because this is heating up the economy. They expect 2.8% GDP growth, gross domestic product. So what that means is their feds get concerned about inflation. And it was reiterated just 2 days ago, I think, that the Federal Reserve, or maybe I read it in Kiplinger tax letter, that they're still looking at 3 rate increases this year to try to keep inflation under control, because wages are going to go up. In Denver, we have a labor shortage, but we're not the only state. Michigan and other states are experiencing labor shortages. So we have to find a way to address that. And I try not to make any political statements. I'll just say that we need to find a good way to find employers, trade schools, because the educational tax credits, or not tax credits, but the student loan limitations and the student loan provisions that say a bank gets guaranteed. And if you don't pay off your student loan when you go to collect Social Security, they can start seizing some of your Social Security. I think is a bad provision, and here's why. The reason it's a bad provision is because there's not a lot of accountants coming out of schools. There's not a lot of attorneys coming out of schools, because if you have to have a master's degree, now you've got half again as much student debt, and wages haven't kept up to be able to handle that. But those aren't the only two professions. People are tired of coming out with mountains of student debt that they can't get out from underneath. And therefore they don't go into those professions, and because the wages haven't increased. So what's the natural recourse? Wages are going to have to increase, cost of products are going to have to increase, inflation is going to occur as just part of the adjustment through the natural cycle of business. Does that make sense?
Yeah, I was just curious if there was any provisions about retirement plans or contribution amounts or anything like that.
So what I've just said is preemptive to answering that. Part of the concern is how are people younger than 50 going to handle retirement planning? So cash value life insurance may or may not. Absolutely talk to a professional about that. But 401ks, Roth IRAs, if you're old enough, a defined contribution plan as opposed to a defined benefit plan might come into play. The only commentary I've seen is that if you're 50 and above, Social Security is not going to change. They're going to increase the Social Security wage base. So this year it's 127, next year might be 128 or 130,000 that FICA will be paid on. Medicare taxes are paid on 100% of your wages. So they'll increase the amount of money going into Social Security. The concern is the number of workers that, as the age base shrinks a little bit, but after the baby boomers, there's a constriction in the number of older workers available to fill some of the executive spots. So they want to encourage younger people to put money away for themselves. Roth IRAs are a great idea. But if you're under 50 and you're not sure about Social Security, then you should be contributing more, because if Social Security has difficulty, they're going to raise the retirement age, and they will possibly reduce benefits on today's schedule. So,
Jay, let's do this. Let's take up that question at our next workshop. We're actually going to have a workshop February 7th is our next Prosperion workshop on Medicare and Social Security, and I think those are questions that we can address at that point.
Right.
We really appreciate you taking up all the complicated stuff that happened in the new bill. You guys remember when they wanted to call this tax simplification? Well, not so much. It's the CPA Full Employment Act, maybe, but we are grateful to you for your expertise, for the work you've done in preparing today, and the way you've let us learn a bit about it this morning. So again, that workshop will be February 7th. Watch your emails. We'll have something coming out about that very soon. Before we wrap up, any other questions in the audience here in the room? Yes, sir.
I have two kids, one in first grade and second grade, and I send them to private school. And I know how much the tuition, I can't deduct the tuition as it is now, but can I donate to 529, that amount that I pay for tuition, and take it off on my taxes and take that out right away?
It's deductible only on the state taxes.
Only on the state.
Right, and even if you contributed 70,000, the only amount you can pull out per child is 10,000.
Yeah, their tuition is 6,000.
Yeah.
So I could get some tax relief.
Yes.
In effect, you reduce your
taxable income for Colorado income tax purposes.
Yeah, only. Okay.
$300 each, so
Yeah.
I can save you,
300?
they save you about $300.
Great, and again, for our online audience, thank you so much for joining us. If you have questions, please call us, your Prosperion advisors, and we'd be more than happy to help you or get you in touch with Jay or consult your tax professional. Thanks for being here in the room. Thanks for being here online. We appreciate you coming.